Welcome back to the Daily Crypto Roundup. Wall Street is finally embracing crypto. That sounds like the kind of sentence that, a few years ago, would have sent Bitcoin flying, Ethereum ripping, altcoins exploding, and everyone on crypto Twitter screaming that the next bull market had officially arrived. But here is the problem. Wall Street is embracing crypto, and prices are still falling. Bitcoin has been weak. Ethereum has been weak. Altcoins have been hit even harder. Retail interest feels quieter. ETF flows have turned negative. Confidence has been shaken. And for a lot of people watching this market, the obvious question is, if the institutions are finally arriving, if the infrastructure is finally being built, if the rails are finally being laid, why does the chart still look so ugly? That is what we are breaking down today. Because this is one of the most important contradictions in crypto right now. On one side, the long-term story has arguably never looked stronger. Banks are moving in. Asset managers are moving in. Stablecoin infrastructure is being built. Tokenization is becoming a serious Wall Street theme. Custody is improving. Regulation is clearer than it used to be. Exchanges are becoming more integrated with traditional finance. The idea of 24/7 markets is no longer some fringe crypto fantasy. It is becoming part of the broader financial conversation. But on the other side, the price action is not rewarding any of that yet. And that is where investors need to be careful, because infrastructure does not always equal immediate price appreciation. Before we go deeper, this episode is brought to you by Kraken. If you are buying, selling, or holding crypto, Kraken gives you access to major assets like Bitcoin, Ethereum, Solana, and XRP on one of the most established crypto platforms in the market. As always, only invest what you can afford to lose. And if you want to support the show, you can use the Kraken link in the episode description. Now let's get into the real story. The big mistake people make with crypto adoption is assuming every positive development should instantly show up in the price. A bank launches crypto custody, people expect Bitcoin to pump. A payment company expands stablecoin infrastructure, people expect Ethereum or Solana to pump. A new tokenization platform launches, people expect altcoins to move. A major institution says blockchain is the future, people expect the market to turn green overnight. But markets do not work that neatly. There is a huge difference between building infrastructure and creating immediate buying pressure. Infrastructure is the roads, the bridges, the payment systems, the custody layers, the compliance tools, the trading rails, and the settlement networks. It is the stuff that allows bigger money to enter the market safely, legally, and at scale. But infrastructure itself does not always create demand immediately. Think about it like building a motorway to a new city. The motorway is important. It makes future traffic possible. It connects the city to the rest of the country. It makes development easier. But the moment the motorway opens, it does not mean millions of people instantly move there. First you build the access, then businesses arrive, then confidence grows, then activity increases, then the value shows up over time. That is where crypto might be right now. The rails are being built, but the market is still waiting for the traffic. And this is why the current moment feels so frustrating. Because the adoption story is real, but the price reaction is delayed. Wall Street is not ignoring crypto anymore. That era is over. The biggest institutions now understand that blockchain infrastructure, stablecoins, tokenized assets, and digital settlement are not going away. Even if they do not love every crypto token, they understand the technology is becoming part of the future financial system. Stablecoins are a perfect example. For years, people treated stablecoins as just something crypto traders used to move money around exchanges. But now stablecoins are being discussed as payment infrastructure, cross-border settlement infrastructure, dollar distribution infrastructure, and financial plumbing for the internet economy. That word matters, plumbing. Because when people hear stablecoins, they often think of a coin sitting at $1. Boring. No upside, no moonshot. But the real value may not be in the stablecoin itself. The real value may be in the companies that process it, custody it, regulate it, settle it, route it, insure it, monitor it, and plug it into banks, apps, and merchants. That is the infrastructure story. And the same applies to tokenization. Tokenization is not just a buzzword. It means putting real-world financial assets onto digital rails. Stocks, bonds, treasuries, private shares, funds, real estate. Maybe one day, entire markets that trade faster, settle faster, and operate outside normal market hours. This is why Wall Street is interested. Not because every banker suddenly became a Bitcoin maxi, not because every hedge fund manager suddenly cares about decentralization, but because blockchain rails can potentially make markets more efficient, more global, more programmable, and more accessible. That is the part people need to understand. Wall Street is not necessarily embracing crypto in the same emotional way retail embraced crypto. Retail embraced crypto as rebellion, opportunity, speculation, and escape. Wall Street is embracing crypto as infrastructure. That difference matters. Retail wants 10x. Wall Street wants settlement efficiency, fee capture, custody control, new products, tokenized assets, global liquidity, and another layer of financial rails it can monetize. So when we say Wall Street is embracing crypto, we need to ask, what exactly are they embracing? Are they buying Bitcoin aggressively today? Are they buying Ethereum aggressively today? Are they rotating into Solana, XRP, Chainlink, Avalanche, and tokenization coins? Or are they building the systems that allow them to profit from crypto over the next decade, whether prices pump this month or not? That is the key distinction. Because right now, a lot of the adoption is happening at the infrastructure layer, not necessarily at the spot buying layer. And that helps explain why prices can still fall. The second reason is macro. Crypto is still a risk asset. It can have the best long-term story in the world, but if investors are worried about interest rates, inflation, recession risk, geopolitics, or liquidity drying up, crypto can still get sold. This is especially true when Bitcoin ETFs see outflows. ETFs made Bitcoin easier to buy, but they also made Bitcoin easier to sell. That is the part people forget. The ETF was not just a one-way machine for infinite inflows. It opened the door both ways. When institutions want exposure, ETF flows help. But when institutions de-risk, rebalance, or take profits, those same products can become a source of selling pressure. So yes, ETFs were a massive milestone. Yes, they legitimized Bitcoin. Yes, they brought crypto deeper into the financial system. But they also connected Bitcoin more directly to traditional portfolio behavior. That means Bitcoin can now be treated more like a macro asset. If funds are reducing risk, Bitcoin can get hit. If yields are attractive elsewhere, Bitcoin can get hit. If there is a major liquidity squeeze, Bitcoin can get hit. If investors rotate into AI stocks, private market IPOs, or other high-growth stories, Bitcoin can get hit. And this is another major point. Crypto is not the only speculative game in town anymore. A few years ago, if you wanted high-risk, high-upside, future-facing exposure, crypto was one of the clearest options. Bitcoin, Ethereum, Solana, DeFi, NFTs, meme coins, layer ones. That was where a lot of speculative energy went. Now AI has taken a huge amount of that attention. Investors are looking at artificial intelligence, chip companies, private AI firms, robotics, data centers, energy infrastructure, and potentially huge IPOs. That matters because capital is not unlimited. Attention is not unlimited. Retail risk appetite is not unlimited. If the public believes the next 10 times is in AI or a massive tech IPO, some of the money that might have gone into crypto can move elsewhere. That does not mean crypto is dead. It means crypto is competing for attention again. And this is where the psychology becomes brutal. Because crypto holders are watching positive infrastructure news arrive at the same time as price weakness. That creates confusion. People think, how can this be bearish when the fundamentals are getting better? The answer is, it can be fundamentally bullish long-term and still bearish short-term. That is not a contradiction. That is markets. A company can build better products and still see its stock fall if earnings are weak. A country can build better infrastructure and still have a recession. A crypto market can gain institutional rails and still fall if liquidity leaves. This is why I think the phrase adoption needs to be used more carefully. There are different types of adoption. There is speculative adoption, where buyers come in because they expect the price to rise. There is utility adoption, where people use the technology because it solves a problem. There is institutional adoption, where major firms build products, custody solutions, and trading access. There is regulatory adoption, where laws and frameworks become clearer. And there is cultural adoption, where the public starts caring again. For a full bull market, you usually need several of these at once. Right now, crypto has made huge progress on institutional adoption, infrastructure adoption, and regulatory acceptance compared with previous cycles. But it is still lacking the explosive speculative adoption that drives price vertically. That is the missing ingredient. The pipes are being built. The institutions are preparing. The products exist. The custody is better. The stablecoin rails are stronger. Tokenization is becoming more serious. But the crowd has not fully returned. And until the crowd returns, prices can stay heavy. This is especially true for altcoins. Bitcoin can survive on institutional allocation and store of value demand. Ethereum can survive on network effects, staking, layer 2s, and financial infrastructure. Solana can survive if usage remains strong and developers keep building. XRP can survive if the payment and banking narrative keeps attracting attention. But smaller altcoins need liquidity. They need excitement. They need retail. They need stories that spread quickly. And when risk appetite is weak, altcoins get punished first. So the real question is not, why is crypto falling if Wall Street is adopting it? The better question is, what kind of adoption is happening? And when does that adoption become direct buying pressure? Because that is the bridge the market has not crossed yet. If tokenization grows, which chains capture the activity? If stablecoins expand, which networks settle the volume? If banks offer crypto access, which assets do clients actually buy? If 24/7 markets become normal, which platforms win? If real-world assets move on-chain, which infrastructure becomes essential? If institutions build crypto products, do they hold the underlying assets, or do they simply profit from fees? Those are the questions that matter. Because not every piece of crypto infrastructure is bullish for every crypto token. This is another uncomfortable truth. Wall Street can embrace blockchain and still not pump your favorite altcoin. Banks can use tokenized deposits and not buy meme coins. Payment firms can use stablecoins and not need every layer 1 token. Asset managers can launch crypto products and still focus mainly on Bitcoin and Ethereum. Tokenization can grow massively, and the value may accrue to exchanges, custodians, compliance firms, payment processors, data providers, and selected blockchains, not automatically to the whole market. That is why this phase requires more selectivity. The lazy version of the bull case says, institutions are here, everything goes up. The smarter version says, institutions are here, but we need to identify where the value actually flows. That is the deep dive. Crypto has not failed because prices are weak. But crypto also has not automatically won just because Wall Street is building infrastructure. We are somewhere in the middle. This is the transition phase. The casino phase of crypto is colliding with the infrastructure phase of crypto. The old market was driven by hype, leverage, memes, retail mania, easy money, and cycle psychology. The new market is being shaped by ETFs, regulation, tokenization, custody, stablecoins, institutions, and macro liquidity. That is why it feels different. And that is why some people are getting shaken out. They are expecting the old crypto reaction to new institutional news. They expect every announcement to produce a candle. But the market is maturing. It is becoming more connected to global finance. That can create deeper legitimacy, but also slower reactions and more macro sensitivity. So where does that leave us? In my view, the current weakness does not destroy the long-term crypto thesis, but it does expose a weakness in how people talk about adoption. Adoption is not a magic button. Infrastructure is not a pump signal. Wall Street interest is not the same as immediate spot demand. ETF approval is not the same as permanent inflows. Tokenization is not the same as alt season. Stablecoin growth is not the same as every coin going higher. The bullish case is still there, but it is more patient than people want it to be. If this infrastructure keeps growing, crypto could be building one of the strongest foundations it has ever had. Better custody, better regulation, better access, better payment rails, better tokenized asset markets, better institutional credibility, better integration with traditional finance. But the market still needs liquidity. It still needs demand. It still needs confidence. It still needs a reason for investors to stop selling and start accumulating again. And until that happens, prices can remain weak even while the foundations improve. That is the uncomfortable truth of this cycle. The technology can be winning while the chart is losing. The infrastructure can be improving while portfolios are bleeding. Wall Street can be moving in while retail is moving out. But if you are thinking long-term, this is exactly the phase to study carefully. Not emotionally, not blindly, but carefully. Because when the next real wave of liquidity returns, the winners may not simply be the loudest coins. They may be the assets, networks, and companies sitting closest to the actual infrastructure being built now. That means Bitcoin as the institutional reserve asset, Ethereum as the settlement and financial infrastructure layer, Solana as the high-speed consumer and trading chain, XRP as the banking and payments narrative, stablecoin infrastructure as the hidden engine, tokenization platforms as the bridge between Wall Street and crypto, and exchanges like Kraken, Coinbase, and others as the front doors into the whole system. The market is weak right now. There is no point pretending otherwise. But the bigger picture is not that Wall Street rejected crypto. The bigger picture is almost the opposite. Wall Street is accepting the rails, building the products, preparing the infrastructure, and positioning itself for a more digital financial system. The price just has not caught up yet. And maybe that is the real story. Crypto is no longer waiting for permission. It is waiting for liquidity. Drop your thoughts in the comments. Do you think Wall Street adoption will eventually send crypto higher? Or is this just infrastructure being built while retail gets left behind? Smash like, follow the show, check out the Kraken link in the description if you want to support the podcast, and as always, we will see you at the top.